Hey, it's Richard with Matthews Wealth Management. We're going to do our end of the year 2022 update. It's mid-December right now, but we've got holidays coming up, so I'm not going to do this during that time period. So I figured I'd just go ahead and knock it out now. A lot of this is kind of a repeat, I guess, from last month, but there are some changes, which kind of interesting. Stay tuned for a reallocation video. We just did a bunch of trades. I think it was 19,455 trades. So yeah, we'll see how that pans out, but a lot of stuff in here I'll kind of allude to for that. So jumping right in here, NASDAQ, we used this slide system last time. I think it worked okay. Talk about it in comments. If you like whiteboard, I can go to the other room, but this does take a while to build out, but whatever. So NASDAQ is what we're tracking here. They're down 32%. So from November, we saw kind of a up and down, chaotic. I think actually I'd cut off right here on this bump. Not much has happened NASDAQ since. Actually, quite a bit has happened in the world of finance, but just in general, you've got the slide. We did another 50 basis points here in December. Not unexpected, nothing strange out of CPI. Everything is normal as far as expectation, but everybody wants to panic and freak out. And anyway, we've accelerated some losses again into the NASDAQ world. S&P still down about 20%. Again, this was kind of the spike. You saw a higher gain in S&P in general, and it's going to be on the value side, just hint, hint. But another sell-off starting here in the last couple of days. That was post-ECB. Christine Lagarde got incredibly hawkish, and now there's a bunch of Italian debt that's concerned, but blah, blah. Won't get into too much of that. Again, we've had a big increase in the moderate, and what this comes from is the bonds. Bonds have really taken off here, and it's part of the concern I think that portfolio managers have is missing out on yield, and I'm one of them. I've been saying that for quite a while, but yields in 4.5% range we hadn't seen in a decade and a half, so it was something to start buying back into bonds. A lot of people that didn't see it coming, I guess, lost a lot of holdings on the way down or value in their holdings on the way down, and they've just held on to it. Part of our reallocation was buying back into bonds. Maybe we're about 2 weeks too late, but still I think we're early in the world. As rates are going up, there's still interest rate risk, right? So it's just a matter of dollar cost averaging and extending your duration in bonds for capturing that yield for the long term for clients. We're dealing with long-term financial goals. We like to have long-term duration for these higher yields, but you don't want to jump too early. And so it's just kind of this weird timing thing. But that's why we saw only a 13% decline. If you recall, throughout the year, we've seen S&P down 20, moderate down 19, right at it. And it was mainly because of interest rate risk in the bonds that were selling off like crazy. Well, they've rebounded. And that's what you're starting to see in these, I guess, 50-50 portfolios. 60-40s should be doing a little bit better as well relative to the full S&P. So let's look at the asset classes here. Large cap, mid cap, small cap. I put multiple numbers up here just to be confusing because you know me. But actually, just 1 month. This is the month of November. That's the most recent ending month data for asset class performance. So we've got the 1 month, and then I just went ahead and threw year to date, since this is the last one of 2022. So if you can tell, large cap value is the only positive equity asset class for the year. Call it flat, but 0.2%. They were up 6% in the month of November to finally cross that zero line. And you can just see the 7, you've got a couple of high 6s down there, another high 6 on mid cap value, but negative 14, 13, 13, negative 2, negative 6, 30, 30, 30, right? That's where everybody got hammered this year. People that were chasing the returns of NASDAQ and Tesla and everything growth oriented, they're the ones that got absolutely hammered. Kind of like karma, I guess. But the gist of what we're starting to see is 2 straight months in a row. October and November, we saw very large equity rebounds, right? And so it's the pivot, guys. Here we go again. Everybody's talking pivot, like the Fed's gonna change their mind. I think the Fed's made mistakes. I think that they just have a flawed understanding of basic economics, like most people do. but they're going to do what they're going to do, and this pivot is not coming. However, the equity markets do like that. Now it's nosedive with what ECB did relative to debt and what that's going to cause the Fed to do. There's just kind of dominoes that ripple out through this, but in general, that's what's pushing equities up, and that's also what's starting to push bond yields down, meaning people are buying back into bonds, like I already hinted at. So anyway, it's just kind of interesting to say. If I just threw the 1 months up there, you'd say, well, everything's great. Well, not so much. You're still really rough if you held on to those NASDAQs throughout the year. So international, wow, it's up 14 for the month, but it's still down 13 year to date. So that just shows you how far that came. Again, it's just this dovish, hawkish thing about interest rates. Isn't it amazing that central planners have so much control over the value of our assets? There's a problem with that. The system is incredibly flawed. If the market could set interest rates, we wouldn't need to wait on what Jay Powell or Christine Lagarde or what they think in their flawed thinking. But this is what you see when you have to guess on what people who are in control of an economy can do. Same thing in emerging markets. They're still down 20%, even with a 11% rebound on 1 month's return. So, yay, I guess. Bonds. This is crazy, right? So bonds, this is the big spike that's helped out the moderate index, right? So the long-term bonds specifically up 8% on the 1 month. They're still down 22% for the year, which isn't as bad as 30, right? It's been just as bad as stocks, just because of raising interest rates. It hurts the value of bonds. Tips are down 10% for the year. Those are inflation protected, guys. Something's flawed with that, right? High yield bonds up 2, still down 10. Wow, look at that. High yield bonds are actually doing better than Treasury inflation protected securities year to date. Go figure. Long-term bonds, the safest thing out there. Yeah, right. Intermediate term bonds down 7, but bounce. And short-term bonds still down 3.5 in an inflationary environment. That's strange. We've been much heavier in short terms than long terms, and we're starting to build out our duration again into some of these higher bond yields. Oil took a turn, right, for the worse, and this is recession fears, right? People are thinking the demand's going to drop off. I mean, how much oil demand is elastic, right? I mean, there's driving. I'm not going to drive as much. I'm not going to fly, or I'm not going to go on a cruise. Great, that's a part of it. I'm not going to buy as much Chinese stuff that has to come across the ocean, but there's basic needs, right? There's a floor, if you will, of energy needs, and this is a fear that those needs are going to drop somehow. So who knows what that's going to be, but still, by far the best performing asset class of the year. We've been incredibly heavy oil. We restructured a little bit of our commodities mix, a little less oil going forward, not based on demand though, more based on supply. So stay tuned for that allocation video. Gold, wow, this is completely surprising to me, but not really if you think about it. Gold is still down for the year, go figure, inflation, but it's in the world of rising interest rates, so people prefer bonds to gold that doesn't pay any interest. That's the theory, at least, regardless of asset value. But in this last month of 6.77%, has anybody heard of FTX? That fraud, the guy should be going, actually he was arrested, but worse than Madoff in my opinion, but whatever, he's young, so we'll see how harsh they are on him. 6.77% are the crypto bros coming into gold saying, wow, we don't trust this whole system right now. Is it really my money? Who knows? Is any money really your money? But ultimately, gold had a big influx of investors that were currency hedging, as they were. A lot of people use crypto as a currency hedge. That's good. I'm actually for that. I actually like decentralized finance. I need to do a crypto video. But anyway, real estate is rebounding slightly. Go figure. And high interest rates and private equity left. And we've got other videos for that one. But negative 23% still year to date. It's kind of caught up. Still not as far down as I thought it would get, but we'll see how that continues. And then we'll just cover the indices for, this is year to date on NASDAQ down 32, S&P down 19. Moderates are down 13.7, and we're down about 12. So good, bad, whatever. We were heavy commodities and very low on our exposure to bonds, and that has been what has helped us out. And if your investment manager didn't see interest rate risk coming, he did not take Finance 101, so you've got a salesman. Anyway, if you got questions, leave them in the comment section, give us a call, whatever. We're here to help. See you next time.